So we're looking at the cash budget, and our question is, was it May 2016? May 20? May 2016. CPA, May 2016, question number 4. So May 2016 is number 4, before we look at the other types of budgets. So the question reads, Mark Limited, is it Mark Limited? Operates a budgetary control system. So the following is the company's income forecast for the months period ending 31st August 2016. So be given the sales, cost of sales, gross profit margin, expenses. Then we have additional information. Number 1, administration expenses include depreciation of 1.8 million each month. Number 2, 20% of sales are on cash basis. Number 3, credit sales are collected over 3 months period, with 20% collected in the month of sale, 65% in the months following the month of sale, and 15% in the second month following sale. Number 4, sales for the month of March 2016 and April 2016 totaled to 27 million and 33 million respectively. Number 5, inventory purchases are paid for within 15 days. Therefore, 50% of the month's inventory purchases are paid for in the month of purchases, and the remaining 50% paid for in the following months. Accounts payable for inventory purchases as at 30th April 2016 totaled 11,100,000 shillings. That is 11.1 million. Number 6, the companies maintain it is ending inventory level at 25% of the cost of the merchandise to be sold in the following months. The merchandise inventory as of 30th April 2016 amounted to 5.25 million. Number 7, land costing for 4.3 million will be purchased in May 2016. And number 8, dividend of 1.3 million will be declared and paid in July 2016. Number 9, the cash balance on 30th April 2016 amounted to 8.2 million, and the company must maintain a cash balance of at least this amount at the end of each month. In case of any deficit, a bank overdraft is obtained. So required for the 3 months ending 31st July 2016, prepare A, debtors collection schedule, 6 marks. B, creditors payment schedule, 6 marks. And C, cash budget, 8 marks. Total marks, how many marks? 20. So they want us to prepare the data schedule. So we'll start with the data schedule here. Data's schedule. So what is this? This is a schedule that shows, so the budget period, that is the period that is covered by the budget, is only 3 months. That is from ending, for the 3 months ending July. So if it ends July, then the budget period is from when to when? May, June, July, isn't it? But you see, someone might have bought the goods in earlier months, and he pays within that budget period. So your analysis should start from the first period you've been given. So here, we're going to write all the months. We're going to analyze how the amount of money is going to be received from sales. Debtors means credit, sales. So we have sales, we've been given sales from March. So we start from March, we have April, we have May, we have June, we have July, and then we have August. So we have the sales here. So the sales for the month of March was 27 million. Of course, they're in thousands. These are in thousands. Shillings are in thousands. So this one was 27,000. The sales for the month of March is in note number. For the month of March is in note number 4. which is 27 million or 27,000. Then April is 33. May, we have been given is 45. And then June is 55. July is 75. And August is 50. So these are the sales values. These are the sales values. So we've been told 20% of sales are on cash base, are cash. So we get the cash sales here. We get the cash sales here. Cash sales is 20% of the total sales. So 20% of this one is, 20% is the cash sales. %20 of 27,000, 5,400. So this is 5,000. So this one is 6,600, 9,000. This one is 9,000, 11,000, 15. And the other one, 10. Now the remaining sales will be credit sales. This one will be the credit sales. The difference between the total sales and the cash sales. So we get the credit sales. So this one will be 21,600, 26,400, 36,000, 44, 60, 40. Now we analyze how these credit sales are going to be paid, how the cash is going to be received from the credit sales. We go to the instructions. We're being told credit sales are collected over a 3-month period with 20% collected in the month of sales. So receipts, 20% debtors, 20% debtors. The receipts of 20%, so those ones are collected in the month of sales. 20% of this credit sales. So we get the 20% of this credit sales, this one. 43, this other one, 52, 80, 7,200, sorry, 8,800, 20,000, 12. This other one, 8,000. So that is the collection of the 20% debtors. So they pay within the same month, collected in the month of sale, isn't it? 65% in the months following the month of, so 65% of these credits. So receipts, you write here receipts, 65% debtors. So 65% of this, not the total, 65% will be collected in this month, isn't it? So how much is that? 14,040. And then this one, 17,160, 23,400, 28,600, 39,000. Is it so? That is this 65% of this is 39,000. It's correct. Tumelewana. And then now, so we have already dealt with 65 plus 20 gives you how much? It gives you 85. So we remain with 15, isn't it? And 15, the second month following the month of, so we write here receipts, 15% debtors. So 15% of this one, it will be collected here, isn't it? So that is how much? 32, 40. This one will be collected here. 39, and this other one could be collected here. 5,000, and the other one, 66. Now we come and just confine ourselves to the budget period. We want to see the total amount of money that is received from debtors within the budget period. We want to see the total receipt from debtors within the budget period. So the budget period is, you said it's May, June, and July. So now this is this one, this, and this. So these 3 figures. So you add this, 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 the receipts. So we add these 3 figures. Cash sales hiyo tutaweka tu direct. So tunaona cash from debtors alafu cash sales. Tuta-separate hizo mbili. Hakuna shida. So unakuja ngapi? This one. 27. And this other one? 36 one. And the other one? 46,000. So this one is not, so that one would be our data schedule. So we have indicated the cash. This is the cash. This is the amount of money we're going to receive from the cash sales. Then we have also shown the amount of money that we're going to receive from debtors. So by so doing, you get how many marks? So when it comes to debtors, just follow the way they have told you. If just told you that this is, just follow it. So the key thing there, you just follow the instructions. Very easy. Then we go to the next, the creditors payment schedules, isn't it? So creditors, we pay them as a result of credit purchases. So we need to have the figure of purchases for us to be able to follow up the payment. So we have here in this question, we'll have to determine the purchases, isn't it? We have not been given the purchases. So we have not been given the purchases. So we have been told this. So we have been given the cost of sales, isn't it? Cost of sales is equals to opening stock plus purchases minus closing stocks, isn't it? So in this question, we have been given, we are able to get the cost of sales. We have been given the figure for cost of sales. We can as well be able to compute the opening stock, and we can as well determine the closing stock. So now we need to determine the purchases when we have those three ingredients. So we make the purchases our subject matter. So our purchases here, our purchase is going to be, this one is going to cross the other side and become positive. So it's going to be cost of sales plus closing stock, isn't it? Minus opening stock. So let us get the stocks. Let us get the stocks. So we can get the stocks here. We can get the stocks. So determination of the stocks. So we have the month of May, June, and so we have May, June, July, and August. Is it so? Then number 5 says inventory purchase, sorry, not number 5, number 6. Note number 6. Note number 6 says the company maintains its ending inventory level at 25% of the cost of the merchandise to be sold in the following months. So it means that the closing inventory in any month is equivalent to 25% of the cost of the sales of the next month. So the closing stock of any month is the same as 25% of the cost of sales of the following months, isn't it? So you get here the closing stock. The closing stock is equivalent to 25%. So now the closing stock in the months of May, it will be 25% of the cost of sales in June, which is 28,000. So 25% of 28,000 is how much? So the closing stock here is 7,000. Is it so? And then the closing stock in June will be 25% of 42,000. That one will give you how much? 10,500. Are we together? We are saying the closing stock in any given month is equivalent to 25% of the cost of sales of the next month. So now the cost of sales in June is 28,000, isn't it? So 25% of 28,000 is 7,000. That is the closing stock in May. Wanasema closing stock in any month, closing stock in any is equivalent to 25% of the cost of sales of the following month. It's equivalent to 25% of the cost of sales of the following month. The closing stock now in May will be 25% of the cost of sales of June. So what is the cost of sales in June? 28,000. 25% of that one is how much? Then now we go to the closing stock in June. It will be 25% of 42, which is, this one will be 5,000. This one, isn't it? We are not interested in August. We are not interested in August. Now we come here and determine the opening. We determine the opening stock. The opening stock tumepewa. The opening stock in April is, the closing stock in April have been given, isn't it? So the closing stock in April will be the opening stock in May. So this is 52.50. Where are we given? We are given in note number 6, isn't it? So we all are aware the closing stock in May will be the opening stock in. So the opening stock here will be 7,000. Here it will be. So we have the cost of sales. We have the cost of sales. We have the closing stock, and then we have the opening. We can determine the purchases, isn't it? So now determination of purchases here. You can write here determination of purchases. We can write here determination of purchases. Determination of purchases. So we said it's a cost of sales, isn't it? So that is May, June, and July. So we have the cost of sales. Cost of sales in May is how much? 21,000. In June is how much? 28,000. In July, 42,000, isn't it? So we said we add what? Closing stock. So we add closing stock here. Closing stock we had in May is how much? 7,000. 10,500. And then we less opening stock. 52.50. This one is, and then this is 10. So now the purchases. 22,750. 31,500. $37,000. So this one is 37. So these purchases are all on credit basis. So we determine how they are going to be paid. So we write here creditors schedule. Creditors schedule. So we write creditors schedule. So we determine how the purchases are going to be paid. So we have here May, June, July. So we have here total purchases. 22,750. This is 31,500. 37,000. So this one we determine how they are going to be paid. So being told in note number 5, inventory purchases are paid for within 15 days. Therefore, 50% of the month's inventory purchases are paid for in the months of purchase, and the remaining 50% paid for in the following months. So you pay 50% in the month of purchase, and the 50. So accounts payable for inventory purchases as at 30th April 2016 total to. So they had arrears. That is, it means the half of April was 11. So a half payment, isn't it? We can say here a half, and then payment another half, isn't it? So in this month of May, we had a half for April, isn't it? Which is 11,100, isn't it? 11,100. And then now we pay a half of this one. A half of that one is how much? 55? 22,750 divided by 2, or 11? 11,375. So we pay a half here and the other half here, isn't it? So this one is paid a half here. Then you're going to pay half of this one here. How much is that? 15? And then the other half here, isn't it? This half of this one? 15? 18,500. The other half will be paid outside the budget period, isn't it? So the total payment will be, so the total payment here, it is these two figures. Add these two figures. That is the total payment in the respective months within the budget period. 34 to 50. So that is the payment in July. Which one? 24? $27? 125. So by so doing, you get 6 marks. At that point, we have accumulated totals 12 marks. Yes. 32? 32 foot where? Which one? This one. The last payment. This one. May. May, you got what? You got 32 foot. This one. May here. You got what? Of 21,600. No. So you see, we said 20% is this one. Okay? 65% is this one. Are we together? So 65% is paid in the following month. The month following the month of sale. Then this one is paid here. So this one, the 20% is paid in the month of March, isn't it? Are we together? 20% of the total credit sales is paid in this month. Is it so? And then 65% is paid in the following month. Then 15% is paid here. The stock was? The stock. The credit sales was 30? On March? It wasn't credit sale, this was total sales. Yeah, so the credit sales will less 20% cash sales. And then now this is the credit sale. See, 27, mine is 27. Sales for the month of March. Sales for the month of March is 27 million, isn't it? Is it 27, 37? Even mine. Yes. Yeah. So now at that point, we can now make what? We can make our cash budget. So what is the name of the company? Mark Limited. So you have the Mark Limited cash budget for the quarter ending. For the quarter ending, ending 31st July 2016. So here we have May, June, July. These are shillings and thousands. You can just indicate somewhere here. Shillings and thousands. So we start with the balance go down, the cash balance. The balance go down at the beginning of the period was how much? 8,400. Where? No, number 9, isn't it? So here you write here 8,400. And then here you write receipts. Receipts, we have cash sales. Cash sales in the month of May was 9,000. And then the other one, 11,000. 11,000 and then we have cash from debtors. Cash from debtors. So 27,000, isn't it? 27,000. The other one is 36,160 and 46,000. Huh? 27,600. Eh? Tumeelewana hapo? Do we have any other source of income apart from the income from sales? Where is it? Dividend they pay, dividend will be declared and paid. So they are not receiving, they are the one paying, isn't it? So those are the only sources of income. So we can leave some space here because, so here we write here total receipts. And then here you write payments. So payment. So we write here suppliers or creditors. So suppliers, they are paying suppliers in the month of May, 22,475. This is 27,125, and this is 34,250. Then we check for other. Then we go to note number 1. Administration expenses include depreciation of 1.8. So when you're preparing cash budget, you exclude non-cash items. We explain what are non-cash items that you can repeat. We said non-cash items are those items that do not involve movement of cash, like for example, depreciation provisions. So those ones are not included in the cash budget. So we write here administration expenses, admin expenses. They will pay administration expenses in the respective months, but you exclude 1,800. So for the month of May, it is 5,500. You eliminate 1,800, isn't it? I don't know, give you how much? 4,100. But we are only looking at admin. It will be 3,700. And then May, June, 4,100. So what you're doing is, we're taking the total administration expenses for every month and deducting 18. This one is 5,100. So we are through the administration expenses. We got number 2. We have already done number 2. Number 3, it was on sales. That one we have done it. Note number 4, we have done it. Note number 5, we have done it. Note number 6, we have done it. Then number 7, land. Sorry. Number 7, land costing 4.3 million will be purchased in May. So they will purchase land in May. How much? 300,000, isn't it? And then number 8, dividend of 1.3 million will be declared and paid in July. So they will pay dividend here. Dividend of how much? 1.3, isn't it? In July. So 1.3. So the cash balance, so they must maintain. So then we have some other expenses, isn't it? So we have selling expenses, isn't it? So we have selling expenses. So nothing has been mentioned about selling expenses. So it is 7,000 for May, 8,000, and the other one is 11 to 200, isn't it? And then we can have here total payments. So this one you can say A, this one is B. Then here we have balance carried down. So now another thing that we have been told is that their closing balance must be at least 8,400. If it is less than 8,400, they borrow. So we're going to check first before we conclude. We're going to add all the receipts and see, check the ending balance, whether it is the minimum will be 8,400 or will be less. If it is less, we borrow the difference to make it 84. So can we add this total? 8,400 plus 9,000 plus 27,600. What do you get? 45,000. So the total is 45,000. And then you add the payments. 37,475. The difference? Sorry? 75? So when we check all the receipts and payment in the month of May, they will give us a balance of 75.25, which is below the minimum, isn't it? So now what is the difference to make minimum? 875. So here they will borrow here, bank overdraft. They will take a bank overdraft here. Of how much? 875, isn't it? So now 45 plus 875, now the total receipts will be how much? 45, 875. And the total payment was 45,000, isn't it? Is it so? 37, 475, isn't it? So this will give us a balance of 8,400. So we'll also start with that one in the debt. The only thing is now you pay overdraft here. This overdraft must also be paid in the second month, isn't it? So we pay one overdraft how much? 875. So we also check whether, in addition to paying the overdraft, whether the minimum balance will be 8,400 or less. If it is be less, we also take another overdraft. This is 5, 45, 60, 660, 55, 55, 660. This one is, and the payments, huh? 4,500, yeah? And then the balance, is 15,000, huh? 15,000. So it is greater than 8,400, isn't it? So we don't borrow here. 1560. Can you also see? Eh? 760 payments. $51,850. And then it is 24 to 10, isn't it? So that is how that question should have been done. And it answers you. So cash budget is very sensitive. So you need to know how to do it. So that one will bring us to the end of cash budget. We want to look at another budget. So I'll give you a minute or so to take a copy of this. $200, eh? It's not 72,000, is it? So now we want to look at another budget. We call it functional budgets. We call them functional budgets. So we want to do what we call functional budgets. So we're going to do functional budgets. So these are budgets prepared according to functions. Function is a department within the business, within the organization. So here, you expect to know how to prepare number one, sales budget. You expect to know how to prepare the sales budget. Number two, production budget. Production budget. And number three, material usage budget. Material usage budget. And number four, you're supposed to prepare what we call material purchases budget or purchases budget, material purchases budget. Material purchases budget. And five, labor budget. Labor budget. So those are budgets that you're supposed to be able to prepare. So now the first one, sales budget. How do you remember? Budget is an estimate. So if you're preparing you are estimating in advance based on some other factors, your experience in business, you can be able to estimate the total value, the total quantity of sales. So how do you prepare the sales budget? The sales budget, you take the estimated sales units, you multiply by the selling price per unit. So this one, you take the estimated sales units, you multiply by selling price per unit. And then the production budgets. So now let us demonstrate it in a question. The first question we're going to do in regard to this is May 2017. May 2017, question number 4. May 2017, question number 4. Sorry, no, question number 5. May 2017, question number 5. Question number 5. Question number 5B. May 2017, number 5B. So we're going to learn from that question how to prepare these budgets. So the question reads, Marimat Limited manufactures a single product branded PQ. So the budgeted sales for the month of June 2017 amounts to 10,000 units at a selling price of 2,000 shillings per unit. Additional information number 1, 1 unit of PQ requires 2 components, namely X and Y, as follows. Component X, number of kgs or liters, whatever it is. And then unit cost of each component. Number 2, stocks at the beginning of the month are budgeted as follows. 4,000 units of finished goods and unit cost is 1050. Component X, 16,000 units at a unit cost of 20. Component Y, 9,600 units at a unit cost of 10. Production cost for each unit requires the following labor hours. So be given the production 4 hours, finishing 2 hours. Note number 4, factory overheads is absorbed into unit cost on the basis of direct labor hours. The budgeted overhead for the month is 1,920,000 shillings. Number 5, administration, selling, and distribution overheads for the month are budgeted at 5,500,000 shillings. Number 6, the company plans plans a reduction of 50% in quantity of finished goods at the end of the month and an increase of 25% in the quantity of each input component required for the month of June 2017. Number 1, sales budget. And number 2, production quantity budget. Number 3, material usage budget. Number 4, material purchases budget. Number 5, direct labor budget and budgeted incomes, budgeted profit and loss account. So this is a very good question. So the first one, they want us to make what we call the sales budget. So how do you make the sales budget? You're saying the sales estimate. Those units that you estimate to sell, you multiply by the selling price per unit. So they are producing only one single product called PQ. So they estimate according to according to the first statement there. So they estimate to sell 10,000 units during that particular month. So we're going to take 10,000 units that it's meant to sell, and each unit is going to be sold at. So the sales budget will be 20 million. So that is the sales budget. Then number 2, Roman number 2, they want us to do what? Production budget. Production budgets, these are the units that you want to produce. So this one is equals to sales units. Sales units, finished goods, plus closing stock. Closing stock units, finished goods, minus opening stock. Opening stock units, finished goods. So this is quantity. It is not in form of money. It is in form of units, isn't it? So if you want to know the units that you're going to produce, they are those units that you're going to sell, plus what you're going to retain at the end of the period, minus what you started, isn't it? So that one will give you what you're going to produce. So here they are only producing an item called PQ. This is a unit that they. So the item is called PQ. This is the one that they're going to produce. So the sales units, this is 10,000 units. So they estimate, and then the closing stock. So closing stock, according to note number 6, the company plans a reduction of 50% in quantity of finished goods at the end of the month. So the closing stock of finished goods should be equivalent to 50% of their opening stock. So the closing stock should be equivalent to 50% of the opening stock. The opening stock of finished goods have been given in note number 2, which is 4,000 units. So the closing stock will be how much? 2,000. Then the opening stock is 4,000. So this one will give you the 8,000 units. So these are the units that they're going to produce. These are the units that they're going. I don't know that together. So they are going to sell, they estimate to sell 10,000 units. What are the closing stock? So they estimate to have 50%. Their closing stock should be equivalent to 50% of the opening stock, according to note number 6. The company plans a reduction of 50% in quantity of finished goods at the end of the month. So they want their closing stock to be equivalent to 50% of the opening stock. So the opening stock is 4,000. So the closing stock should be how much? 2,000, isn't it? So they plan to, that is the budget. Is that okay? That is number 2. Number 3, they want us to do what? Material usage. When they require material usage, that one should be there. The title or the heading or the should be there. So there are 2 kinds of material. They have material X and material Y. When they ask you for material, that one should be the title or the heading. Are we together? So they want you to produce, to make material budget, how many, the quantity of material they're going to use to produce these units, isn't it? So for us to produce 1 unit of component PQ, we need a combination of 2 materials. That is material X and Y. So now this is the production. This is the production. they're going to produce 8,000 units will require this material, and 8,000 units will require this material, isn't it? So we've been told in note number 1, for you to produce one unit of product PQ, you need material X, 5 kgs of material X, and 3 kgs of material. So 1 unit requires 5 kgs of material X. What about 8,000? So you multiply, isn't it? So you're going to multiply by 5. This one, we're going to multiply by, so we need 40,000 kgs of material X to produce 8,000. And then we need 24,000 kgs of material Y to produce. So that is the material that is required or will be used in production. So that is material usage. And then number 3, they want us to do what? Number 4, they want us material purchases budget. Material purchases budget. So the material that you're going to purchase is equivalent to material that you're going to use. So this is material usage. This is equivalent to material usage plus material usage plus closing stock raw material, closing stock raw materials minus opening stock raw material. So the material you're going to purchase is equivalent to the material that you will use in production plus what you will retain at the end of the period minus the one you had at the beginning. So we have material X and material Y. So material usage here. Material usage here is 40,000 kgs. This one is 24,000. Then closing stock of raw material. Closing stock raw materials. So we've been told the company intends to increase, the closing stock should be equivalent to 125% of the opening. Note number 6, the company plans a reduction of 50% in the quantity of finished goods at the end of the month and an increase of, so the closing stock of raw material will be equivalent to 125% of the opening stock, isn't it? So closing stock will be 125% of 16,000 for material X and 125% of 9,600 for material Y. The closing stock will be equivalent to 25% more. That is 125%. So how much will that one be? 12,000 for X, 20, isn't it? And then we less opening. Opening stock here will be 16,000 and here's 9,600. Then we get the quantities that will be sold. Sorry? Mandika vice versa. This is 20,000. And this other one is 12. So, ukitoa 44. And the other one? So this is in kgs. Mostly this one, you have to do it both in kgs and money. So these are the kgs that they're going to buy, but each kg is how much? Here you multiply by 20 and here by 10. So this one must be both in money and in kgs. How much do you get? 264. 264. And this other one? 880. So these are shillings, isn't it? So that is a budget. That is the material usage budget. Sorry, material purchases budget. Then now we come here and prepare labor. They want us to do labor. Labor budget, it is the amount of money they're going to spend on labor in production, isn't it? So they have two departments. They have a department called production They have a department called production, another one called finishing. So these units must go through this department. These units that are going to be produced must go through this department and these two. So here you write here production. Production, these are 8,000 units, isn't it? These are right. So this 8,000 will require 4 hours per unit in production, isn't it? So we multiply by 4 to get the number of hours, which is 32,000 hours, isn't it? So these are hours, and each hour is paid at 100. So you multiply by 100 to get money. So how much do you get? 32, 3 million. So that is the amount of money they're going to spend on labor in production department. And here, each unit requires how many hours? 2 hours. Total hours, 16 hours. Then each hour is paid at 140. So how much are they going to pay? 224. 224. Like this. 2240. Evio. Correct. So, and then lastly, they want us to do what we call the budgeted income statement. Budgeted income. So when they tell you budgeted, anything to do with income, we have revenue, we have the cost of production or cost of sales, and then we have, so here we have shillings and thousands, and then here we have shillings and thousands. So we have the budgeted sales. So the budgeted sales is how much? 20 million, isn't it? And then you less cost of sales. You less cost of sales. Cost of sales, we have opening stock. Opening stock units of finished goods was 4,000, isn't it? Valued at 10.50 per unit. That is according to note number 2. So this is the value of this is a unity, the quantity, and this is the value per unit. So how much is that one? So this one will be 4,000. And then you add, this is a manufacturing entity. You add production cost, isn't it? So you add production cost here. So they are producing how many units? And then you just value it at 10.50. 10.50. 8,000. 400 or 200? 4. And then you less closing stock. Closing stock is how many units? 2,000, isn't it? Then these are closing stock of finished goods. Closing stock of finished goods. So this one will give you 2,100. And then you take $10,500. And then you get the gross profit. 9,500. Then you less, we have admin, selling and distribution expenses. How much is it? 5,000. So the production overheads are already captured in the production cost per unit. So you ignore it. So when you're producing, the total cost of production will be the material cost, isn't it? Labor cost and overhead. So already overhead is already here in this cost. So you don't bother about it anymore. Then you get the difference. Here is how much? 4,000. So that will be the profit. So that is how we do this kind of questions. We need to do another one, so you can write that one very fast. So we have also December 2012, question number, December 2012, question number, This number 2012, question number what? Question number 5, isn't it? So you can open that one. December 2012, question number 5. December 2012, question number 5. So you take a photo of that one very fast. We can respond to them before we move on. Ulikuwa umeenda wapi? Ishazima. Okay. Another question of this kind. So December 2012, DEC CPA, December 2012 CPA, DEC 2012 question number? Question number 5. 5? C. So the question reads, is it Kilna or Kilma? Kill Limited manufactures and sells a single product. The financial year of the company ends on 31st December every year. The following data has been collected from the for use in preparing companies' quarterly budgets for the financial year ending 31st December 2013. So we have the sales forecast. Note number 1 is as follows. Number 2, standard material requirements and cost per unit. Note number 2. Then the opening stocks are expected to be as follows: finished goods, materials. Number 4, at the end of each quarter, closing stock of finished goods are expected to be 10% of the next quarter's sales requirement. Number 5, the closing stock of raw materials is expected to be higher than the opening stock by 10%. Number 6, sales for the quarter ending at 1st March 2014 are expected to be 36,000 units. Number 7, as from 1st July 2013, the selling price per unit is expected to increase by 10% from the current price of 600. So require the sales budget in value for each quarter, 3 marks. Production budget for each quarter, 3 marks. Material usage budget in units for each quarter, 3 marks. The material purchases budget. So here they want us to prepare. So they want us to prepare. The first one is the sales budget. The sales budget in money form, in value. So we have 4 quarters. So here we have quarter 1, quarter 2, quarter 3, and quarter 4. So these are the sales units. They estimate these are the sales units they expect to sell. Quarter 1 is 32,000 units. Quarter 2 is 40,000 units. Quarter 3 is 24,000 units. And quarter 4 is, so those are the sales estimates. And then the selling price per unit here. The selling price, SP. SP stands for selling price. That is note number 7. As from 1st July 2013, the selling price per unit is expected to increase by 10% from the current price. So a quarter has 3 months, isn't it? So this is the 4 quarters in a year. Each quarter has 3 months. So the first quarter will be January, February, and March. Then April, May, and June. And then from July now, the price will increase by 10% from the current price, which is, so it means the first 2 quarters, the price is how much? 600. Then it will increase in these other 2 quarters by 10%. So it will be how much? So this one will be 660. This one will be 600 and per unit. And then you multiply. So when you multiply the first one, eh? 200,000. This one will be the value, eh? So that one will be there. That one will be the sales budget. Very easy to get. How many marks? 3 marks. Then number 2, they want us to prepare what? Production budget. So how do you prepare the production budget? We said production budget is equals to sales units, finished goods, isn't it? Minus plus closing stock units, isn't it? Finished goods minus opening stock. Opening stock, finished. We're preparing per quarter. So we have Q1, Q2, Q3, and Q4. So this one is in units. So here we have the sales units. Q1 is 32,000. I hope you can be able to see. That is the first note. 40,000. This other one is 24. And then here we write closing stock. Closing stock. So I've been told the closing stock, note number 4, at the end of each quarter, closing stock of finished goods are expected to be 10% of the next quarter sales requirement, isn't it? So in other words, the closing stock would be equivalent to 10% of the sales requirement of the next quarter, isn't it? So 10% of this one will be the closing stock here, which is 4,000. This one will be 2,400. This one will be 3,000. Then we have been given the sales for the first quarter in 2015. Is it 2014? These are the quarterly requirements for 2013. So being given the sales units in the first quarter, that is a quarter after this one. So that one will be 36,000, isn't it? So the 10% will be how much? 3,000. So the sales requirement after the fourth quarter will be 36,000, isn't it? That is the first quarter in 2014, isn't it? That is in note number 6. Sales for the quarter ending at 1st March 2014 are expected to be 36,000. Umeona? Then here we list opening stock. Opening stock, we have been given the opening stock here, the first quarter, isn't it? So we list 3,200, isn't it? We've been given the opening stock are expected to be as follows. Finished goods is 30,200, isn't it? So the closing stock here will be the opening stock in the second, isn't it? So this one will be 4,000. This one will be 2,000. And this one will be 3,200. So the closing stock in one quarter will be the opening stock in the other quarter. So here we get the production units. This one, 32. The first one, 32. So that is a production budget. So Melewana. Then number 3, they want us to do what? Material usage. So they have 3 kinds of materials. They have material X, that one will be the title, material X, material Y, and material Z. So they want us to prepare material usage budget in units for each quarter, isn't it? So we have Q1 here. Q1, we are producing 3,800 units. Is it so? So we said if they ask you for the budget they have asked you, that one will be the heading or the headlines. The heading will be the budget. So if they want the material, the title should be materials, isn't it? So that one material X, Y, and Z. So we're producing 3,800 units in Q1. Each unit requires 5 kgs of material X. So you're going to multiply this one by 32,800. Huh? 164. So this one will be 164,000. Yeah, kgs. Then the same units you multiply by 3.75 for material Y. How much do you get? Huh? So this one will be 123. Then Z, 82,000. This one will be 82,000. Then we go to quarter 2. So in other words, this is the total quantity, this is the total kgs we need for material X in quarter 1. Are we together? Then we go to quarter 2. We're producing 38,400 units. You multiply by 5, you multiply by 3.75, and then you multiply by 2.5. The first one, huh? So this one will be 182,000, 92,000, this one, 192. $96,000. And then we go to quarter 3, 24,800. Huh? 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 81. So now, if you want to know the total material that you're going to use in the whole year, you add it downward. This is the total usage. The total usage for material X, material Y, and material Z. 642. Eh? 321. 321,000. So that is the total material usage for those two. And then lastly, material purchases budget. Number 4, material purchases budget. So material purchases budget is material usage is equals to material usage plus closing stock raw material, closing stock raw material minus opening stock raw material. So we have material X, material Y, and material Z. So the material usage here, so they want us to prepare for the whole year, isn't it? So they want us material purchase budget for the year. So this material usage is 642 here. And this is 481, 500, and this is 321. Then closing stock raw material. Closing stock raw. So I've been told the closing stock in note number 5. The closing stock raw material is expected to be higher than the opening stock by 10%. So the opening stock you have been given for material X, which is 3,002. So the closing stock should be higher by 10%. So it will be how much? 10%, 1.1 times 3,200. 35? 35.20. So the closing stock should be higher than closing stock by opening stock by 10%. So if you had opening stock is given in note number 3. So this one will be how much? It will be 55? 55.20. Which one? This one? 57.20. And last one? The last one, 10%, 110, 1.1 times 800, 880. Then we less opening stock. Opening stock is 3,200, 5,200, and 800. So that is material purchases in quantity. 32,080, 642, why? Which one? This one is 482, 482.0, like that. So you multiply by money, you convert it into money. This one is, the price is how much? 15, and this other one, the price is 12, and this is the price is 30. So you also get 321. See 320. Easy. I will multiply. Ganyo. 96. Na hiyo ingine. Sorry? 57, 84, 40. Na hiyo ingine. 240. So this is in shillings and this is in kgs. This is in kgs. So that is how we do those. Then now assignments. Assignment for the same. Assignment, make sure you do the assignments. This one, you make sure you do it. Make sure you do it. So we have November 24, November 2004. This is very important. Question number 4. November, question number 4. Question number 4. That is CPA. And then we have for June 2011. This June 2011. May 2011, question number 3B. May 2011, question number 3B. And then latest here, let me confirm. Then September 2021, question number 4. September 2021, question number 4. So those are the questions on functional budgets. I don't know that I can get a question on cash budget. Let me see. November 2019, question number 5B. November 2019, question number 5B. So you can attempt those questions. And then, so we are remaining with what we call master budgets and standard costing. So you do a lot of revisions. So that one will be the end of our class today. So next time we'll be finishing up with the master budget. That is on Friday. And hopefully we can set our standard budget, standard costing. That is variant analysis. And we'll finish it up on Sunday. So that is the end of our class today.